Could this be Warren Buffett's most surprising move yet? The Oracle of Omaha, known for his undying loyalty to Apple, has been quietly unloading massive amounts of its shares. But here's the real shocker. He's not just selling. He's buying into completely different companies. 2 brand new stocks have entered his portfolio, and they might just reveal his vision for the future. Let's dive into the moves that stunned Wall Street and the hidden strategy behind them. Let's start with the Apple sell-off. Over the past 4 quarters, Buffett has offloaded a staggering 615 million shares of Apple. That's a 70% reduction in his stake, worth over $150 billion at today's prices. Yet, even after all that selling, Apple remains his top holding at $70 billion or 25% of Berkshire Hathaway's portfolio. But why sell Apple, the crown jewel of his investments? The answer might lie in Apple's unprecedented valuation. With a market cap of $3.8 trillion, yes, trillion, Apple is the most valuable company in the world, trading far higher than peers like Microsoft, Google, and Amazon. It seems Buffett is cashing in on Apple's success while the market is still red hot. This isn't just about taking profits, though. Buffett has been stacking cash like never before. Berkshire's cash reserves have skyrocketed by 177% in just 2 quarters, now sitting at over $325 billion. This enormous war chest signals one thing: Buffett is preparing for opportunities, whether that's a market downturn, a strategic acquisition, or both. But here's where it gets really interesting. According to recent SEC filings, Buffett isn't just holding cash. He's deploying it into brand new investments. Let's break down the 2 new comparations to Berkshire's portfolio, starting with Pool Corporation. Pool Corporation, or Pool Corp, POOL, is the largest wholesale swimming pool and supplies company in the world. Berkshire invested over $150 million into this niche market leader. Pool Corp's dominance in its industry makes it a classic Buffett pick: strong market position and steady demand. However, its reliance on discretionary spending makes it vulnerable to economic downturns, as seen with an 11% revenue drop last year and another decline expected this year. Valuation-wise, Pool Corp's forward P/E ratio remains significantly higher than its sector average, and its dividend yield of just 1.4% leaves much to be desired. While it fits Buffett's value dividend mold in theory, I'd say this pick is more of a long-term play on recovery than an immediate winner. Next up is a surprise addition to Buffett's portfolio: Domino's Pizza, ticker DPZ. Berkshire poured nearly $550 million into this fast food giant. Domino's has become the leader in the global pizza market, with operations in over 90 countries and ambitious plans to open 5,000 more stores. Despite its dominance, Domino's growth hasn't been as robust as expected. The stock trades at a 30-50% premium to its peers, while offering a dividend yield of just 1.5%. That said, Buffett may be banking on its proven ability to expand and maintain market leadership. Now, let's talk about a stock that's more in line with Buffett's traditional style: Verisign, ticker VRSN. Buffett added 234,000 more shares, bringing the total value of this position to $2.5 billion. Verisign dominates the domain registration market, providing the backbone for internet giants like .com and .net domains. With consistent mid-single-digit growth and a recent 20% dip in share price, Verisign looks like a solid value play. While it doesn't pay dividends, its steady cash flow and market leadership make it a long-term winner in Buffett's eyes. What sets Buffett apart from most investors is his impeccable sense of timing. While others chase growth stocks or speculate on the next big thing, Buffett moves against the tide. His decision to hold cash and wait for the perfect opportunity may seem passive to some, but history tells us this approach often leads to massive payoffs. Take the 2008 financial crisis, for example. Buffett's ability to deploy capital into distressed companies like Goldman Sachs and Bank of America led to billions in profits for Berkshire Hathaway. Could his recent actions signal another moment like that on the horizon? His focus on recession-resilient stocks like Verisign, alongside discretionary plays like Domino's and Corp, shows he's betting on a balanced strategy to weather market turbulence. Let's zoom out for a moment. Buffett's decision to sell Apple and hoard cash isn't happening in a vacuum. The economic landscape is shifting, with rising interest rates, persistent inflation, and fears of a looming recession. For an investor like Buffett, these aren't just numbers, they're signals. During uncertain times, Buffett's strategy often involves two key moves: stockpiling cash for future bargains and investing in companies that can weather an economic storm. His increased stake in Verisign, a business with recurring revenue from domain registrations, is a textbook example of recession resilience. On the other hand, his investment in Domino's and Corp shows a measured willingness to bet on consumer recovery once the dust settles. Could this mean Buffett sees an opportunity in the chaos? History tells us that his most significant plays often come during economic downturns, and if there's one thing the Oracle of Omaha has mastered, it's making money when others are panicking. So, what's the takeaway here? Buffett's recent moves show a clear strategy: trim the high flyers like Apple, amass cash, and invest in steady, market-leading companies. Whether it's swimming pools, pizza, or domain names, Buffett is positioning Berkshire Hathaway to thrive in an uncertain market. If you enjoyed this breakdown, hit that like button and let me know in the comments. Do you agree with Buffett's latest picks? And don't forget to subscribe for more deep dives into the strategies of the world's top investors.